Where are the best producing assets that BP has right now?
Well, last year we had 6 major projects come on stream. We have another 5 this year. Gulf of Mexico, Thunder Horse is a great example where we brought forward a project from this year into 2018 that came on in the third quarter. And that's helped drive the production growth you've seen this year, 8.2% underlying production growth year on year. And as you say, that's led to actually a strong set of results, both the fourth quarter and the year overall.
You've also made some investments in U.S. shale. Those assets are some of the ones that you've been bringing online as well. I just wonder, shale assets have been the ones that have been kind of most prone to some of the new technology that we've seen. What is the baseline in terms of how profitable oil has to be, or what price oil needs to be at in terms for it to be profitable for BP with all these new assets that you have?
Yeah, so you're alluding to the $10.3 billion acquisition of BHP's position, which gave 3 positions, 1 in the Permian, 1 in the Eagle Ford, and 1 in Haynesville. It depends on where you are in each of these zones, depends on how profitable those barrels are. But if you actually look at what's happened with the oil prices in places like the Permian, the Midland price has come in now. It's trading at 60 cents below WTI. Only a year ago, it was $12 below. And I think as you see more infrastructure come in, it makes those projects more profitable because the netbacks you're getting for the oil are that much higher. So it really does depend upon where you are in the lower 48. But we see it as a great investment. And we brought those assets in at the end of October last year. So we saw 2 months benefit of that in our results at the back end of last year. But there's more to do this year as we take over operatorship of them in March from BHP. And then we start to ramp up activity, both particularly in the Eagle Ford and then in the Permian.
Brian, what are your assumptions for the range for oil prices, or oil and gas prices, if you like, at this point? What's built into your guidance? And I guess, how are you investing on that basis?
Yeah, I think the first big point is for last year we were balanced at $50 a barrel Brent, so sort of 45 TI. We're fully balanced. That is our capital programs covering capex and dividend on a full basis. So that's the sort of first point. I think in terms of where the oil prices are today, they look like they're firming up around $60. I mean, I think, we saw the third quarter last year, they got a little bit ahead of themselves, up to around $80 a barrel. I think that's because the market perceived with the Iranian sanctions coming on that would take serious supply off the market. Then the Iranian waivers came and therefore the supply actually stayed on the market and prices dropped off significantly. I think if you look at where prices are today, around $60, $62 Brent, looks pretty firm. I think for this year, it's really going to be about supply and the OPEC and the non-OPEC agreements in terms of curtailing supply on the market. I think demand looks pretty robust. I think last year, first half of last year, we've seen demand around 1.7 million barrels a day. That dropped off to about 1.3 by the end of last year. And I think this year we're looking at 1.3, 1.4 million barrels a day. So I think this year, oil prices, it's really going to be about supply.
So Brian, given that it's going to be about supply, where do you put the willingness and the ability of OPEC plus Russia, to stabilize oil prices?
Well, I think they've done it. I think you've already seen it now. If you saw in December, I think Saudi Arabia production was down at 10.3 million barrels, at 10.2 million barrels a day, versus their curtailed target of 10.3. And in January, it looks more like 10.1. So we're already seeing significant volumes come off the market from the peak of 11. You've still got disruption issues with Libya. There's about 300,000 barrels a day off the market. Venezuela, I mean, the sanctions will kick in, but I think the oil will find new homes because those sanctions are limited to the US. And I think it's really then about OPEC. But it looks to me, based on what we've seen in the most recent conversations, it looks pretty firm in terms of trying to hold prices around these sort of levels.
Brian, your stock's up today because the street was surprised by the strength of the results. Part of that is that the company was much more efficient than the street had been anticipating. What do you see happening this year in terms of how you can kind of turn that needle even tighter?
I think it's more of the same. And I think one of the things that drove the high reliability and performance last year is the fact actually it was one of our safest years of operation that we've had in over a decade. That meant the kit was running that much better. And I think as we see more reliability coming through the kit, the main thing is to be sure that we can operate these assets and take advantage of these higher prices while they appear. I think the first quarter will be a bit of a headwind. We've got some big turnarounds, particularly Thunder Horse, but then it will open up as the year progresses.